Opendoor had another big run up this week. So I decided to do a discounted cash flow analysis and see if this is meme stock or actually a good value. Opendoor is sort of like the Carvana of homes, where they'll buy your home for cash, renovate, and resell it. They have slim margins, usually 4 to 6%, but obviously home sales are huge transactions. They're recently pivoting from just flipping to being a platform working with agents. They have a new Cash Plus product and a Zillow partnership. Latest results, their Q2 was 5% growth year over year at 1.6 billion homes sold, an amazing 4,299 gross profits of 128 million, 8.2% gross margins, not fantastic. Adjusted EBITDA of 23 million, first positive in 3 years, but a net loss of 29 million, much lower than it was before. But their Q3 guidance was brutal, with revenue of only 800 to 875 million, back to negative EBITDA, because their inventory sold down. The housing market in general has been very weak and the buyers have been scarce. This is obviously driven by interest rates, which should be coming down, helping the housing market. They have a good balance sheet with 789 million in cash, and their debt is mostly non-recourse credit lines tied to homes. Their market cap is about 6.7 billion, and that's about $9 a share right now. They have a really good moat because they're the only one with scale. They're sort of, again, like Uber in the sense that the distant competitors are much smaller. They have a Zillow partnership, but the negative parts is they have thin margins, low switching costs, because they're really competing against selling your house via a traditional agent, and they're obviously exposed to housing cycles and the interest rate fluctuations. If you know me, you know return on invested capital is my favorite metric because it shows a company's ability to profitably reinvest in its core business, and it's negative. Do not like to see that. Gross margins of 8 to 9%, net margins negative, but targeting 5% long term if platform model takes off. At a discount rate of 12%, a terminal growth of 2.5%, you give a revenue paths of baseline 30 billion by 2039, bull case 50 billion by 2039, and a bear case of 10 to 11 billion by 2039. Put net margins at 5% base, 8% bull, and 3% bear. The base case puts it at about $8 a share, $9 a share, which is about where it's at right now. And there's wild swings on the bull case going to $20, $25, and a bear case going to $1 to $2. If I put the discount rate at 10% though, then the base case looks a lot better. The base case at a 10% discount rate is $11 to $12 a share. So it's above the current $9 per share, but not a lot of room for error. So this isn't just your typical meme stock. I mean, there is a real business here, has real potential, it's a cool idea, but I like to invest with a large margin of safety. So this is not a no-brainer investment.